In 2022, their history saw inflation rise to 9.1%, the highest level in the past 40 years. When there is inflation in North America, it spreads to other countries and ends up affecting the rest of the world. Therefore, if the United States government fails to control the inflation problem, we could have a much deeper global crisis than what the world is currently experiencing. In today's video, we will explain how the decisions of the United States government led to inflation and why that inflation spreads to the rest of the world. One of the worst things that can happen to a country is printing money, as it is the main cause of inflation. Just as inflation occurs when there is too much money, the way to reduce it is precisely by removing the excess money in the economy. That's why every time a country has printed a lot of money, it has had disastrous consequences. In the case of the United States, they printed a significant amount of money, especially during the pandemic when the government needed money to assist people and businesses that couldn't work due to the quarantine. This graph shows the amount of money available in the United States economy, and we can clearly see how the amount of money increases during 2020. In fact, almost 20% of all US dollars in existence today were printed in 2020. This led to the inflation in the United States reaching 9.1% by mid-2022. However, there is a very important difference between the case of the United States and other countries that experienced high inflation, such as Venezuela. When there was inflation in Venezuela, it only affected that country. In contrast, the inflation in the United States has a global effect. This graph shows the inflation in some of the major countries in the world, such as the United Kingdom, the United States, the Eurozone, India, Japan, and China, between June 2021 and May 2022. As you can see, not only did inflation in the United States grow during that period, but the inflation in all major economies of the world also increased. Of course, part of the inflation experienced by other countries is related to the fact that they also printed a significant amount of money. For example, if we look at the graph showing the amount of pounds available in the United Kingdom, we can see a sharp increase in 2020 due to the printing that took place during the pandemic. However, beyond the fact that these countries also printed money, part of their inflation can be explained by the inflation in the United States. This is due to the power that the dollar holds over any other currency. The dollar is currently the strongest currency in the world for two reasons. First, it is the most widely used currency for international trade, as businesses around the world trust the stability of the dollar. This graph shows international money transfers by currency, and as we can see, the dollar has been the primary currency, accounting for nearly 50% of the total transfers, followed by the euro with 30%. Due to this stability of the value of the dollar, countries in general will prefer to trade in dollars instead of their own currencies. Let's suppose that a company in Pakistan wants to sell products to a company in Argentina. If the Argentine company were to pay in its currency, the Argentine peso, the Pakistani company would have no way of using those pesos in Pakistan. Furthermore, if the Argentine peso were to lose a significant amount of value the next day, the Pakistani company would be in trouble because not only would they have a currency they cannot use, but it has also depreciated in value. On the other hand, if the Pakistani company were to request payment in Pakistani rupees, the currency of Pakistan, the Argentine company would have difficulties obtaining those rupees, and there is a risk that the rupees may lose value after being purchased in exchange. If they conduct the transaction in dollars, they would be using a universally accepted currency that is easily obtainable and does not change its value daily. The second reason is that the dollar is the most chosen currency by countries around the world for their reserves, which are the savings of countries. Just like individuals, countries save money and can do so in currencies such as the dollar or the euro, as well as in precious metals like gold or silver. This graph shows the composition of the total reserves of all countries in the world, and as we can see, almost 60% of those reserves are in dollars. But why does the fact that the dollar is the most powerful currency in the world cause inflation in the United States to spread to other countries? To understand the effects of the United States money printing on the world, we first have to understand an important concept, which is monetary policy. Monetary policy is the set of decisions made by the Federal Reserve to increase or reduce the amount of money in the economy. For example, printing banknotes is a decision related to monetary policy because it increases the amount of banknotes. But just as the Federal Reserve can increase the amount of money, it can also reduce it. One way to do this is through U.S. Treasuries. Treasury bonds are the instrument used by the United States government to borrow money from investors, and the interest rate is the return that the government pays to investors for lending them money. By increasing the interest rate, the government provides investors with higher returns for lending them money, and that's why investors choose to give their money to the government instead of investing it in companies. When investors lend money to the government, the Federal Reserve removes that money from the economy, thereby reducing inflation. The Federal Reserve has been significantly increasing the interest rates of Treasury bonds, from 0.25% in early 2022 to 5% after the latest hike in March 2023. However, this has negative effects on the economy because when interest rates on U.S. Treasuries increase, interest rates on all loans also increase, affecting individual pockets and business sales. Let's see why through an example. When a bank needs money to lend to people, it borrows it from the Federal Reserve. Let's say Bank America borrows money from the Federal Reserve and could obtain it at an interest rate of 6.15% because it must be higher than the Treasury bond rates. This is because the Treasury bond rate serves as a reference for the rest of the interest rates in the banking system, such as loans. If the Treasury bond rate is 5%, any loan offered in the banking system will be higher than that rate to make a profit. Bank America will lend you this money at an interest rate of 8.15% and make a profit of 2%. Let's assume you take a loan of $10,000 from Bank America to be repaid in a year. That means after a year, you would have to repay the $10,000 you borrowed plus $815 in interest. Now, if inflation continues to rise, the Federal Reserve would have to increase the interest rate again to withdraw more money from the economy. If the Treasury bond rate reaches 6%, the Federal Reserve would increase the interest rate it charges Bank America by 1%, making it 7.15%. As a result, Bank America would have to increase the interest rate of the loan they gave you to 9.15% to maintain a 2% profit. That would mean instead of having to repay $815 in interest, you would have to repay $915, which is 12% more. Consequently, you would have $100 less per year to spend because you have to pay more in interest. With less money available, you would have no choice but to reduce your expenses, which means consuming fewer products. The higher the interest rates increase, the fewer products you would consume. If we were talking about a loan taken out at the beginning of last year, your interest would have increased by almost 5%, as the Treasury bond rate increased from 0.25% to 5%. If we apply this analysis to all loans taken in the United States, such as loans for buying houses, cars, credit cards, and travel, among others, we're talking about millions of Americans who will buy less of all these things. The consequence of all this is that as the demand for products decreases, companies will sell less. The first thing companies will try is to lower prices so that people can afford to buy. So, if a car costs $30,000 and people stop buying cars because they can only afford up to $20,000, companies will try to lower the price of their vehicles. However, due to inflation, that becomes impossible because at the same time, car factories have seen their production costs rise. The materials needed to produce cars have also increased due to inflation. Energy prices have increased due to the war between Russia and Ukraine, and the costs of many other components have also skyrocketed due to inflation. As a result, the production costs have increased so much that they simply can't sell the car below $25,000 because they would incur losses. And that's how the economy starts to decline. Buyers don't have money to purchase products at current prices, and sellers can't lower their prices enough for buyers to afford them because production costs have increased. This leads the country into a recession, where people consume less, and as a result, companies decide to produce less and lay off workers, generating unemployment and causing people to have less money. However, just as the Federal Reserve can make monetary policy decisions to reduce inflation, leading the economy into a recession, it can also use monetary policy to stimulate economic growth again. Well, this is where the Federal Reserve applies a monetary policy called quantitative easing. In simple terms, quantitative easing is when the Federal Reserve of the United States reduces interest rates and prints dollars to stimulate the economy. Just as increasing interest rates withdraws money from the market and reduces consumption, lowering interest rates generates the opposite effect. The decrease in interest rates allows people to have more money available, and it becomes cheaper to take out a loan. As a result, people start consuming more, thereby reactivating the economy. This is precisely what the Federal Reserve did during the pandemic. The graph illustrates the interest rate of Treasury bonds, showing that until the pandemic, the interest rate had risen to 2.5%. However, in 2020, due to COVID-related lockdowns, the economy stagnated. To stimulate it, the Federal Reserve printed a significant amount of money, as mentioned earlier, and lowered the rates to a minimum of 0.25%. After banks reduced the interest rates, the amount of money that borrowers had to repay decreased significantly, giving them more money to spend. Additionally, since loans were very cheap, many people took advantage of the low interest rates to borrow money from banks and make purchases. A notable example is car sales, which plummeted during the pandemic but quickly recovered thanks to the lowered loan rates. However, this increased demand leads to price increases. The more people want to buy something, the more expensive the product becomes. As a result of the decreased interest rates, millions of people have more money available, and they can easily request a loan because the interest rates are low, making the installments affordable. The demand for products starts to increase, and at some point, the prices of these products also rise. So far, we have explained how monetary policy works in the United States. But why do price increases in the US lead to inflation in the rest of the world? Let's revisit the reason through an example. Let's assume Volkswagen, a German company, sells a car model for $30,000 in the United States. When the demand for cars increases due to quantitative easing, the company decides to raise its prices and start charging $35,000 for that model. However, at the same time, they sell the same model in Germany for 30,000 euros, which, considering the exchange rate of €1 to approximately $1.10, amounts to around $33,000. This means that if Volkswagen has to choose between selling cars in the United States or in Germany, they will likely choose the US market because they can earn an additional $2,000 per car. As a result, Volkswagen will start exporting more cars to the United States to meet the growing demand and make more money. However, if they send all the cars they produce to the US, they may run out of inventory to sell in Germany. Therefore, they will eventually increase the price of the car in Europe to $35,000, matching the price in the United States and earning the same amount of money in both markets. This is why inflation in the United States leads to inflation in other countries around the world. The graph shows dollar imports by countries, representing the products that countries buy from others in US dollars. Since the United States is the largest importer, the example of the car applies to any other product imported by the US. Whenever the price of an imported product increases in the United States due to increased demand, there will also be a price increase in the country where it is manufactured. However, this is not the only reason why money printing in the United States leads to inflation in other countries. Let's explore the second reason using the Volkswagen example. If Volkswagen wants to sell its cars in the United States, it needs to carry out the transaction as follows. When the US branch of Volkswagen imports 100 cars from Germany, it has to purchase euros to make this purchase since it needs to pay the German branch in euros. This increased demand for euros will cause the value of the euro to rise. The German bank, in turn, will take advantage of this and increase the price of the euro. If the euro was previously sold at a rate of $1.10, the German bank may start selling euros at $1.13. However, Volkswagen won't mind paying 3 cents more for each euro since they will still make more money by selling cars in the United States. As the demand for cars increases, prices will also rise. Now, if the euro continues to appreciate, it will eventually pose a problem for Volkswagen. The problem is that if we look at it from the company's perspective, as the value of the euro increases, the dollar value of the car also increases. In other words, when Volkswagen was selling its car for $35,000 in the United States, it did so because the euro was worth $1.10, and it was beneficial for them to do so. However, as the euro increases, the dollar price of the cars will also increase. For example, if the euro rises to $1.20, the car's value in dollars will be $36,000, which is calculated by multiplying the 30,000 euros by $1.20 per euro. There will come a point where Volkswagen cars become too expensive for US consumers compared to cars manufactured in the United States, and consumers will stop buying Volkswagen cars. If the German government wants Volkswagen to continue exporting to the United States because it generates employment, they will have to print more euros to devalue the euro against the dollar and bring it back to $1.10. The consequence of this decision by the German government, as we saw earlier, is that the money printing generates more inflation in Germany. These are the two ways in which the quantitative easing of the United States leads to inflation in other countries. The strength of the dollar and the fact that the United States has the largest economy in the world mean that the monetary policy decisions made by the Federal Reserve have effects not only in the United States but also in the majority of countries worldwide. That's why investors and governments are closely watching the Federal Reserve and the decisions it makes regarding interest rate hikes. Controlling inflation should be a priority for the US government because failure to do so will have a significant impact globally. Please comment on what you thought about the subject and leave suggestions for new videos. We hope you enjoyed the video. If you liked it, please give it a thumbs up to help us deliver even better videos for you. And don't forget to activate the notification bell so that you receive a notification when we upload our next video. Thank you, and see you next time.